A very good morning, all of you. Can you please confirm if the audio and video and the screen is properly visible and clear to everyone?
Yes, sir, visible.
Good morning, guys. Can you please confirm? All good. Thanks, Vinod. Good morning, Ayushi. Good morning, Kanan. Good morning, Manasha. Good morning, Neha. Okay, now, in the last class, as we discussed that definitely we will be having some extra classes also. So first of all, before we start any topic, I want to announce the schedule of the classes. As announced already to you, the schedule will definitely be Saturday, Sunday, 9 a.m. to 1 p.m. It can vary. It can be up to 12:30 or might be 12 also some days. Don't worry at all about it, depending upon the schedule or the topic that I'm discussing. Additionally, I will be taking up topic on Tuesday plus Thursday. Now, don't worry at all. The timing will be from 7 p.m. to 9:30 p.m. First, okay, Indian time. Okay. Now, those who all are unable to attend these weekday session, don't worry at all. Why exactly? Because the topic that I'm discussing here will be a separate and different topic, okay, different from what I'm discussing in the weekend regular classes. So these will be a different topic, okay. Now, or you can a separate topic again. Then you might say, sir, we will miss the live class of this one. Okay, fine, I understand. So what I'll do, I'll take up less important topics here or easier topics. So for those topics, even if you watch recordings, that is still fine. Okay, so I will cover the topics with which you can cover up with the recordings also. Okay, so that will not be a challenge for you, I believe. Okay, so this is my schedule. Now I will be completing the syllabus max to max by 15th of May and not later than that. Okay, now after that, definitely we will have some practice sessions also, mock exams also, so you don't worry at all about that as well. Before that also we'll have practice sessions, but not mock exams. Okay, mock exams will be there, but not full-fledged. Basically, I want to say 100 marks mock test will not be there. So 100 marks mock test will happen only after 15th of May. Is the schedule clear to everyone? Can you please confirm, is the schedule clear to everyone? Yes, Vinith, we can appear in June. This batch is for June 23 itself. Okay. So when I'm saying the batch will get finished by 15th of May, it means everything will get finished by 15th of May, provided you revise along with the classes. Okay, you're just not doing the classes, but you are revising along with the classes also. That's what I assume. Okay, now moving on to the topic. If everything is fine till here, the schedule is fine. Anyone doesn't have any challenge in the schedule? Because I don't want any further discussion on the schedule going forward. Okay, fair enough. Now let us start with the topic non-current assets. Hari, that depends around 2 to 3 days. It will take around to upload the recordings, so that gap will be there, I believe, around 2 to 3 days. Okay, so that means I'll reiterate the same fact. That means if you miss a Tuesday class, you have to miss Thursday class also. Provided if I announce specifically that in the Thursday class I'm starting some new topic, other than that, if you miss Tuesday class, you will miss Thursday's class also. Okay, but that's not a challenge. I will be covering only those topics in the weekday classes which you can cover with recording also. That's not a challenge. But yes, if you miss Thursday's class, the next Tuesday class you will not miss, definitely. Okay, now moving on to the chapter of non-current assets. Now understand, guys, in SBR, as you are already aware of it, we will be covering IFRS, right, and the IAS. Now non-current assets, the IAS which we cover here in this topic is IAS 16, IAS 38, IAS 40, then IAS 100 and IAS, not IFRS, I'll write here, just a minute, IFRS 13, then IFRS 5 and 36. So these are the basic standards which will be covering in the chapter non-current assets. Okay, now let me tell you the name of each and everything. IAS 16, IAS 38, IAS 40, IFRS 5 and IFRS 13. So these are the basic standards which we'll be covering in the chapter of non-current assets. 16 means property, plant and equipment. 38 means intangible assets. 40 means investment property. 36 means impairment of assets. IFRS 5 means non-current assets held for sale and discontinued operations. And IFRS 13 means fair value measurement. Okay, so these are the list of standards which I will be covering in the chapter non-current assets. But now understand, I will not be moving in this simple manner that I first cover IAS 16, 38, 40. No, the structure of my class will be somewhat different. So first of all, understand what is the meaning of non-current assets. Anyone, guys? And let's make it a quite interactive session. Okay, it's not only me delivering the lectures, rather it should be a discussion session. Okay, now tell me, guys, all of you, what do you understand by somewhat called as non-current assets? Tell me, all of you, what do you understand the term non-current assets? When you hear the term non-current assets, what do you understand actually?
Sir, it's any asset that is
held not for trading within the next 12 months, held for production supply of goods services, and the life is more than 12 months. IUC, that's a definition of property, plant and equipment. Okay, Manasa, it's tangible. So Manasa, does it mean that intangible assets are not non-current assets, which is not a current asset? Not exactly, Vinith. Okay, fine, understand. I'll say any asset which has a life of more than 12 months. Okay, partially what Vinith said is correct, I can say. Okay, now understand, I write here any asset which has a life more than 12 months, not equals to 12 months. Okay, I'm saying a life more than 12 months. Okay, or operating cycle. Yes, Vinith, agree, totally agree. Okay, but let me write here 12 months only. I'm not going to discussion of operating cycle as of now. Okay, life more than 12 months are called as non-current assets. Now these non-current assets can be tangible, can be intangible, and can be financial. Now, please have a look at this chart. So what I'm trying to say here, any assets which has a life more than 12 months are called as non-current assets. Okay. Now, so going by this definition, I can classify any non-current asset into three types. It can be tangible non-current asset, it can be intangible non-current asset, and as you know that intangible asset which are non-monetary in nature are called as intangible asset, right? So the asset which are monetary in nature are called as financial asset. So I am covering here the financial asset as well. So these can be all the non-current asset. Is that clear till here? Any gap, any disconnect here? All of you please confirm. Come on, guys, tell me. Now understand, as we know that the financial asset gets covered under the scope of IFRS 9. So I am not discussing it here. Okay, fine. Now comes to our discussion of tangible assets and intangible assets. Tangible assets and intangible assets. Now understand, any tangible assets which I am having with myself, there can be two purposes. Either I want to use it on myself or I want to give it on rental to others. Agree? whatever tangible asset. Let's suppose I have this studio with me. Okay, now this studio, I'm using it for myself. I have this laptop in front of me, I have this camera, I have this infrastructure of overall studio, so I'm using it for myself. Now, and think of a one situation, I have one more studio which I have given on rental to someone else. So meaning thereby, if I have any tangible non-current assets, I can either use it for my purpose or I can give it on rental to anyone else in the market. Now, so standard says whenever you have a tangible asset, the purpose or the use can be of two types. The purpose or use can be of two types. Sorry. Purpose or use can be of two types. One is self-use and another is rental. No, rental to others. Okay, now whenever you have intangible asset, again the same logic, but now understand what I am trying to do here is I am trying to explain the application of these three standards. I am trying to explain you the application of these three standards, in which case I will apply 16, in which case I will apply 38, and in which case I will apply 40 is what I'm trying to explain here. Now understand. First, now what I'll do here is I will explain the definition of each of them. As per IAS 16 on property, plant and equipment. Okay, it defines property, plant and equipment as a tangible non-current asset held for production or supply of goods or services, rental to others, or general admin purposes. Okay, the life of which is more than 12 months, meaning thereby non-current asset. Simple. Okay, this is the definition of a property, plant and equipment. This is the definition of a property, plant and equipment given in the standard IAS 16. Now let me go to IAS 40. Let me go to IAS 40. It defines investment property as land, building, or both held for rental to others or capital appreciation. Fine. Now understand that. Now try to understand the difference between these two. I am trying to link something now. Understand what happens here in definition of property, plant, equipment, and in definition of investment property. There is something common, which is rental to others. Meaning thereby, if a tangible asset is given on rental to others, it falls under PPE. And when a tangible non-current asset is given on rental to others, it falls under IAS 40 investment property as well. Now this creates a confusion. So now what the standard says, in investment property, that is IAS 40, I am covering only the rental of land, building or both, either land or building or land and building. Okay, so if I am giving land, building or both on rental to others, that is coming under the scope of investment property. And now if I'm giving any other tangible non-current assets on rental to others, that comes under the scope of property, plant and equipment. Now if I have to come here, tangible non-current asset, if it is held for self-use, it will always be property, plant and equipment. It will always be property, plant and equipment. But if it is given on rental to others, I have to assess if it is for land, building or both. If it is for land, building or both, it will fall under investment property. But if it is for any other, it will fall under the classification of property, plant and equipment. It will fall under the classification of property, plant and equipment. Now tell me guys, are you able to understand the difference between property, plant and equipment and investment property? Are you able to understand the definition of difference between property, plant and equipment and investment property? Anyone having any queries, any challenges, any issues? Got it? Okay, fine. Now, intangible assets are intangible assets. There is no challenge in this one. Okay, so this gets covered under IAS 38. So I will be discussing it separately now. So only reason I want to discuss this one was students generally have a confusion that what is the difference between property, plant and equipment and investment property. So that's the whole reason of discussing this point, that this is the basic difference between PPE and investment property. The use, if I'm having any non-current assets for self-use, it is always PPE. For the turnkey projects, will it be under 16 or 40? Depends Vinith. See, whenever I have any turnkey projects, okay, understand, turnkey projects has nothing to do with 16 or 40. Turnkey projects means what? If I have given any project on contract, okay, now it is his responsibility to complete all the everything and give it to me. Okay, give it ready for me, so that I will go and start the project. Now when it is given, let's suppose I have given a contract of constructing any building, to a contractor under turnkey project. Okay, now what will happen, when the building will be delivered to me, it will be ready for use. Now it depends upon me. If I want to use that building for my purpose, it will become you can say property, plant and equipment. And if I want to give that building on rental to someone else, it will become investment property. Is it clear, Vinith? Can we say movable property is dealt under IS 16 and immovable property and under in IS 40 for rental purpose? Satish, you are correct, but partially correct. Okay, but understand, all the non-current movable properties. Okay, on why to say property, I can say all the non-current tangible assets except for land, building and land building given on rental are covered under IS 16. And land building on rental are covered under IS 40. That's what you can say. Okay, so just to give you a quick summary of it, crux. I can say all tangible non-current assets except land, building or both for rental are covered under the scope of PPE, and they are covered under the scope of investment property. Is it clear now? Yes, Tanya, even the investment properties are depreciable. Okay, we definitely will discuss in detail about it. We'll discuss everything in detail for PPE, for IP. Okay, don't worry at all about it. But yes, investment properties are also depreciable, though land is not depreciable. Okay, now this is the basic difference. Now from here, what I'll do is I will start the discussion of a proper standard, that is IAS 16, property, plant and equipment. But before I start that, I want to give a disclaimer here. Now, I'll tell that these three standards, 16, 38, and 40, these three standards run in the more or less the same principles, though there are certain differences between them, but the basic principle behind these three standards remains the same. So what I will do, I will discuss the IAS 16 property, plan and equipment in detail, okay, in detail. But now when it comes to 38 and 40, whatever is the common part, I will not be repeating it again, okay. I will just simply say it is exactly similar to IAS 16 property, plant, equipment, and whatever is the difference, I will be explaining only those. I hope that is clear to all of you. So what is my request to all of you is, when I'm explaining property, plant, equipment, please listen to it carefully. IUC, that's a choice that is with up to you. Okay, definitely after the class, I will be sharing these notes with you. But what I request students always have a pen and a paper with you, okay, and a calculator along with you. What happens when I'm discussing anything, or when I'm saying something, or when I'm explaining something, it might be the case that I'm not writing in the notebook, okay, because that's the explanation that I'm giving. So you have to write those, okay. If you want to write these notes along with the class, you can do that also, but I will say more important is to listen what I'm saying, okay, is to listen, because in SBR, unlike ACCA skill level FR or CA final FR, okay, wherein in ACCA skill level FR or in CA final FR, we are just required to solve questions, okay. But if you see any past paper of SBR, you will find in very less areas we have to give any calculations, and more importantly we have to give explanations, and explanations are what? The why of the standard, the why. So I will be discussing the why. I will be discussing why. So you have to listen to this why very carefully, because this why will not be written anywhere in the book, okay. In the SBR study material, whether you are referring Kaplan or whichever you are referring, you will find what is given in the standard, not anything apart from that. But in the class, I will be discussing why does the standard say like that, okay. Like for example this one, the standard simply says that this is the definition of PPE, this is the definition of IP, but we interpreted and discussed why exactly this happens like this, okay. I hope that is clear to all of you. Now, before we start any standard, I have a general tendency to give you the contents of the standard, okay. So what I'll do, I will give you the contents of the standard, that these are the points which we have to discuss in this standard. So, and what happens when I give this content, at the time when you are revising going forward, okay, you will know that these are the topics that I have to revise, and just by seeing the topics, you can start recalling the concepts and the why that I discussed. And if you are not able to recall any, then you can go and revise that specific part, okay. So what I'm doing is I'm giving you the contents of the specific chapter. So please write down this content along with me. Please write down this content along with me. Content of IAS 16 property, plant and equipment. So first part that we have to discuss is the meaning that we have, though we have already discussed it, of meaning of property, plant and equipment. Now, second part that we have to discuss is a recognition principle. Third part that we have to discuss is measurement principle. Always remember that in any standard whichever we study, okay, you have to study three things mandatorily in that: recognition principle, measurement principle, and disclosures. Now, in measurement principle, you have to understand a few things. What is the initial measurement principle? What is the subsequent measurement principle? Okay, now, fourth point. Whenever you are doing subsequent measurement principle, that is the assets are at revaluation model, okay, then what is the few important points pertaining to asset at revaluation model? Then you can say, what is the treatment of a revaluation gain or loss? Then what is the treatment of revaluation reserve or surplus? This is the fourth point. Now moving to next point, fifth point is specific assets. That is assets acquired on deferred credit terms, provision for dismantling or decommissioning costs, then certain other enabler assets, then assets on exchange basis. Okay, this is the fifth point. Now coming to sixth point. This disclosures. These are the points that you have to study specifically for a property, plant and equipment. I hope that is clear to all of you. And you can write here one more point, just a minute. Sixth, you can write a simple, a small point, which all of us know, depreciation. Just quickly have to touch upon it. And seventh is disclosures. So these are the points which you have to study in IAS 16, property, plant and equipment. I will request all of you to please write the contents. Please write the contents so that you have a ready reference that these are the topics that you have to study. And let me know once done. Let me know once you are done writing the contents. Done. Very good, Tans. Yes, Sital, as I told in the class, I will be sharing these notes after the class. Okay. Now, I'm starting with the discussion on IAS 16, property, plant and equipment. And the first point that we have to start discuss is the meaning. Meaning of property, plant and equipment. So definition, though I've already written, but still I write it again. PPE under IAS 16. Before you ask me, I want to tell you one thing, that in the exam, are we required to write the standard number? No. Are we required to name the standard? No. If you remember, you can write. I will say it specifically and strictly that you should not give even a single effort to memorize the standard name and the number, because the examiner clearly states that there is no credit allowed for the standard name and the number. Okay, so if you remember, fine, you can quote it, but again, don't expect any additional mark for that. If you are not able to recall, don't write. You should not expect any deduction of marks for that. Okay, No need to remember any standard name and the number from an exam perspective. If you want to, you can do it for your own purposes, but not for the standard exam. Yes, in the class I will be stating the name of the standards and the number of the standard multiple times, because I personally want that you should recall it, not for the exam purposes, but for the practical application purposes. You should recall it off, okay, but not required in the exam. PPE under IAS 16 means any tangible non-current asset held for production or supply of goods or services, rental to others, okay, or general administrative purposes, the life of which is more than 12 months. This is the definition of property, plant and equipment. This is the definition of property, plant and equipment. Now understand the meaning. Basically it says whenever you are acquiring any tangible non-current asset, okay, and you want to use that tangible non-current asset in the production of goods, meaning thereby a machinery, or supply of goods, meaning thereby, let's suppose any vehicle, okay, using a vehicle, or let's suppose a truck, for the example, you are using a truck for delivering the goods from the place of production to the customer's place. You are using a truck, so that is also called as property, plant and equipment, okay. So any non-current asset which is held in the for the production or supply of goods or services, okay. Let's suppose a stethoscope which the doctor uses for the imparting services to its patients, that asset is also called as property, plant and equipment, okay. Now if any asset is given on rental to others, that is also called as property, plant and equipment. Now understand one point here. Though the standard says if you have a land, a building or both, and if you are giving this on rental, it is called as investment property. But if standard says that if you are giving anything else on rental, let's suppose I am giving this mobile phone on rental, or let's suppose I am giving this laptop on rental, okay, I am giving this tablet on rental, these are called as property, plant and equipment only. Why? Come on guys, tell me why do you think this happens? Why only the land, building or both given on rental is called investment property and all others are called as property, plant and equipment only? Why? Come on, tell me. Think of it. For the recognition purpose? No. So that's what is my question. Why do you think the standard has done this bifurcation? Exactly, Tanya. That's a wonderful answer. Because the land and the building are appreciating assets. They are held for investment. Now, let's suppose when I'm giving this mobile phone on rental, is that the case? This value will appreciate? No, the value will not appreciate. The value will not appreciate, and hence it is called as property, plant and equipment only. Kannan, the standard doesn't say anything specifically about gold. If there is any gold, okay, we can say that it is it might be held for trading purposes. If it is held for investment even, then also it will be called as property, plant and equipment only, okay. So depends upon the situation. Where the gold can be classified under multiple situations depending upon the intention to hold that asset, okay. Now comes to general admin purposes. What is the meaning of general admin purposes? Let's suppose in the corporate office, there are employees using the laptops, okay. Is it helping in the production or supply of goods? No. right? But they are helping the overall industry to operate. Okay, the corporate office building, see, understand, the building can be of two types: factory building and the general corporate office building. Factory building is helping in the production of goods or services, but the corporate office building where the finance team sits, now, is it helping in the production? No. Is it helping in the production? No. But it is enabling the factory to operate. It is helping the overall practice, right? So that's the reason we capitalize this one also. Is it clear, everyone? And the life should be more than 12 months. That is deemed, as I have written here, non-current asset. Okay. So, but the standard here says what? Any tangible asset. That's the reason the definition states 12 months, just to say that it is a non-current asset. Tell me, guys, is the meaning, the definition clear to everyone? Corporate building is under IS 16. Yes, Satish. Okay. Now, understand, if any particular asset gets qualifies the definition of IS 16, does that mean we will recognize that in our financial statements? Is this my question? I am repeating my question, and please write this question in your books, in your notebook. Okay, please write this question as I'm saying it off. If any particular asset qualifies the definition of being a property, plant and equipment, highlight it. If any particular asset qualifies the definition of being a property, plant and equipment, does that mean that PPE shall be recognized, in financial statements? This is my question. And first you have to try giving the answer for this one, and then after that I will discuss the answer with you. Come on, guys, tell me. First read the question, try to understand it, and then answer it off. And don't worry about that. What if your answer is wrong, or what if your answer is right? Don't worry at all about it. You should be very frank in the class. Whatever answer comes to your mind, please don't feel hesitant in writing that answer in the comment box. Please write it off. Okay, all of you, whether right or wrong doesn't matter. Yes, Vinod, please.
So does this standard having an overriding effect on any other standard?
Ownership. Okay.
No.
Only ownership, Kannan?
I'm saying, like, does this standard is having any overriding effect on any other standard? Like, if you have to apply this, you cannot apply that standard.
Only ownership.
Hello.
And I'll tell you one more thing, Kannan, that when I'm discussing this chapter of property, plant, equipment, I assume that yes, we do have the ownership. Yes, we do have the ownership. Okay. Yes, we do have the ownership, because if we don't have the ownership, definitely I cannot recognize any asset in my books of account. Okay. Vinith, no. It might have some overriding effect from the conceptual framework, which I will discuss it separately. But as of now, no. Okay. Now, so understand, as Manasa said it very aptly, that even if a particular asset satisfies the definition of being a property, plant and equipment, still there are cases that we cannot recognize it as a we cannot recognize it as a property, plant and equipment. Okay, now why, what is the filtering point here? The filtering point is our next point of discussion, that is recognition principle. So I will write the answer here. I write the answer here. No, if any asset, I let you know, even if any asset qualifies to be a property, plant and equipment, it still needs to satisfy recognition principle. Okay, to be recognized in the financial statements. Now, what is the meaning of this one? Meaning thereby, if there is any PPE plus it satisfies the recognition principle, then only it can be recognized as PPE in financial statements. Okay, that's the meaning of this one. Now, having understood this point, we need to understand what is the recognition principle. What is the recognition principle? But before I go to the recognition principle, tell me guys, is this question and the answer clear to everyone? Is this question and the answer clear to everyone? Guys, we'll go step by step. Okay, we'll go step by step. Even if it takes me additional 1 hour to explain any topic, I will take that. But only thing I want to ensure is, once our classes gets over, all the queries should get over by then. Okay, now Vinith has a query that recognition principle is different from the standard. No, recognition principle is a part of the standard. It's not something different. Okay, it says to be recognized in the financial statements, a PPE needs to satisfy the recognition principle as well. Okay, it needs to satisfy the recognition principle as well. Okay, and now understand the recognition principle, the measurement principle and the disclosures are common in each of the standards. Though the recognition principle will differ from standard to standard, but in all the standards you will find there is a recognition principle, there is a measurement principle and there is a disclosure principle. Okay, so these three things will be in all the standards. Okay, recognition principle means, can we recognize this in the financial statements? Can we recognize this in the financial statements? Now, moving on to the next point, that is, what is the recognition principle? A PPE, a property, plant and equipment, can be recognized in financial statement if it satisfies both the below conditions. Now see, my emphasis is on the word both. Okay, now what is the recognition principle? Future economic benefits are probable and Okay. Now what I'll do is, rather than explaining these two conditions separately, I will take up an example, okay, and explain this one. And I'll take up a real example which I have faced. But please, if anyone is writing, please do write it off. If anyone is writing, okay. Yes, please. Because then after that, I'll start discussing it off. If anyone is writing, please write it off and please confirm once you're done writing, and then I will start discussing the concept. But yes, I will share these notes after the class. After every class, I will share these notes with you. Don't worry at all about that. Done. Okay, now understand. Please, all of you, please keep your pen down and listen to me. Only listen to me. Okay, no need of writing anything. So what happened? I purchased a laptop stand for myself. Okay, basically which has some cooling facilities for the laptop. Okay, because due to overuse of the laptop, my laptop gets heated. So I purchased that. Okay. Now what happened? Once I purchased that for, let's suppose I purchased at around 1700, somewhere in that range. I purchased it off. Okay, now once I purchased, definitely it had a life of somewhere in the range of 2 to 3 years. So definitely it was a non-current asset for me. It's tangible, and since I'm using it in the production of or in the delivering of services to you guys, it was a property, plant and equipment for me. So definitely it satisfied the definition of property, plant and equipment. Tell me yes or no. Definitely it satisfied the definition of a property, plant and equipment. Yes. Now, because the life was more than 1 year, and it was held for my use in the delivering the services, and it's a tangible asset. So it is a basically property, plant and equipment for me. Now, after I purchased it off, I found that it is not being valued to me, because once I'm using it, the laptop screen is not basically I am very facing difficulty in using the laptop basically in that case. Okay, because what happens, the laptop becomes tilted and I'm unable to type anything in that. Okay, and basically it is of no use for me. Understand this one. Now, if I am placing a replacement order in return order in Amazon, it is not happening. Okay, therefore you just had a replacement policy. We don't have a return policy, and I missed to read that policy. Okay, so definitely I am not able to utilize any benefit out of that. I am not able to utilize any benefit out of that. First point. Now, if I am planning to return it to Amazon, I am not able to do that. Now, I also placed a request in OLX to sell it off. Okay, I also placed a request in OLX to sell it off, and I'm not getting any buyer for that. I'm not getting any buyer for that because no one wants to buy it off. Now tell me, the stand which I purchased, is it of any value to me? Is it of any value to me? It's not about being repairable. It's in a proper condition. It's brand new. It's brand new. So tell me, is it of any value to me? Is it of any value to me? No, no value. Tell me, will I recognize in the books? Will I recognize in the books now? No. Why? Now, why? Okay, let me tell you one more example. Let me tell you one more example, then you will understand. Let's suppose I have a receivable from one party of ₹100. Okay, I basically gave a loan to my friend of ₹100. Okay, and I know that he is not going to return the money back to me. I know that he is not going to return the money back to me. Tell me, can I continue recognizing that as a trade receivable, or I remove it off? I'll write it off, right? Why? Because that is not recoverable. An asset is recognized in the financial statements. And listen to me properly. An asset is recognized in the financial statements only if it is recoverable. Only if it is recoverable, whether it is a trade receivable or a property, plant, equipment. Okay, if it is recoverable, it is then only I will recognize it in the financial statements. Now, since that stand which I bought, I am having no value of it, and that is not recoverable, will I recognize it in the financial statements? Will I recognize it in the financial statements? No. The standard says no, and that's what is the recognition principle. Even though it's satisfied to be a property, plant and equipment, but still standard says you have to see whether you will get future economic benefits from that asset or not. Future economic benefits are probable or not. If the future economic benefits are not probable, you will not recognize that asset in your books of account. Tell me, is this point clear to all of you? Is this point clear to all of you? Okay, now costs can be measured reliably. Okay, I'll give you one more example. The watch that I'm wearing, okay, the watch that I'm wearing, okay, is gifted to me by my brother. Okay, now on my birthday last year. So what happened when my brother gifted me this watch? Tell me, okay, I am wearing this watch, okay, for self usage. Okay, basically you can say for general admin purposes, the life is more than 12 months, because the general life of a watch is, let's suppose, 24 months or 36 months, in that range, somewhere in that range, okay. And it's tangible, so tangible plus self usage plus life more than 12 months means it is a property, plant and equipment for me. Comes the question, can I recognize it in the financial statements? Can I recognize it in the financial statements? Tell me, is that a monetary transaction? Go back to your class 12. Go back to your class 12. In class 12, when you are studying the journal entries, we discussed one thing. A transaction is something which has a monetary value. Does it have any monetary value? Does it have any monetary value? No. So will I recognize that? No. So that's the second point. The costs can be measured reliably. The costs can be measured reliably. Clear, everyone? Is it clear, everyone? Now, few disclaimer. Neither I have purchased any stand, nor this watch is gifted by my brother. Okay, that's all. Everything belongs to me. Okay. Now, this is the recognition principle. Is it clear, everyone? The recognition principle. Tell me, guys. Okay, fair enough. So understand the examples. Let's understand the examples now. No need to draw this table in your books, in your notebook. Okay, I'm just drawing it, and I'll share this notes with you, so you can take it from there. Right after the class, Hari. Case one. Case one. Let's suppose a camera. Okay. Purpose is delivering of services. Delivering services. You can say I like self-usage. Life is 24 months. Future economic benefits are there, costs are not there. Tell me what should be the conclusion. Tell me what should be the conclusion. No PP. I think it's wrong, Hari and Kannan. Self use means what? When I'm saying self use, I'm not saying for personal purpose, I'm saying from a company perspective. It's a self usage for the company. Okay, so meaning thereby it is a PPE, it is a PPE, but cannot be recognized, but cannot be recognized, but cannot be recognized. Right now, simple. Next, mobile land. Rental 99 years. Future engineer cost is 1 crore. Tell me. PPE and recognized, right? It is a PPE and we will recognize it also. It is a PPE and we can recognize it also. Is land always IP, sweetie? Is land always IP? Is land always IP? My question is land always IP? Yes, I see, I get your point, but my question is something different now. No, right? Understand. Whenever the land, building, or the both is held for rental, the first point is to click here is investment property. The first point is to click is investment property. Okay, now if it's just land, it is not always investment property. If the land is for self usage, if the land is for self usage, okay, basically the entity wants to use the land, okay, for production of goods, then it is a property, plant, equipment. But if the land is for rental, then it will become what? It is not a PPE. It is not a PPE. It is not a PPE. Rather, it becomes an investment property. Now, third point. Building. Factory. Now tell me for this one. PP, and we can recognize it. Why PP? It's a building. It's a building. No, why PP? Because it is used for self. It is used for self. Is held for production. Very good. PP, and we can recognize it also. And we can recognize it also. Very good. Very good. Now, fourth. Land. Self-use. Now, tell me for this one. PPE not recognized. Very good. It's a PPE. Why? Because the land held for self-use is PPE, but cannot be recognized. Why? Because there are no costs. Cannot be recognized. Clear, everyone? So you understood the, see, only point to take up this example was to explain you the relevance of recognition principle. The recognition principle is not something different, but it's a extension of the meaning. Can we recognize with notional value? No, Kannan, you cannot. We cannot recognize the notional value. Okay. No, because it doesn't satisfy the recognition principle itself. So basically, it says that whenever any particular asset satisfies the definition of being a property, plant, and equipment, and it satisfies the recognition principle, it is then only we can recognize that asset as a property, plant, and equipment. And this is what I tried to explain here as well. If you can read this answer, if you can read this question and the answer both again, please read the question and the answer again once. Please read the question and the answer again. I will come to it, Ayushi. Self-use does not satisfy PP definition. Why, Hari? Self-use, why doesn't it satisfy the PP definition? When I'm saying self-use, I'm not saying itself for personal use. I'm saying company's self-use. Company's self-use. Okay. See, production or supply of goods, company is using for its own purpose. Okay. General admin, company is using for its own purpose. When I'm saying self-use, don't think the personal use of the promoter of the company. What I'm trying to say here when I'm saying self-use is self-use of the company. The company is using for its own use. I hope that is clear to everyone. Now, Satish has a query: be the building for the office purpose or production. Both of them will come under PPE. Yes, Satish. Now, IUC had a query that future economic benefits from using and selling both. No. From here, when I'm writing here, I mean to say only use. I mean to say only use. I mean to say only use. But sell will come where? I'll explain, though I don't want to, but let me explain it off. See, IFRS 5 means what? Non-current assets held for sale. So now what happens? Here, these three assets will come here. These three assets will come here. Now the intention will be to sell here, right? So here I will take the fair value from or future economic benefits from sale. I will take the future economic benefits from sale here. Is it clear? Okay. Now, if a land is vacant, then it will be a case of investment property. Why and how I will discuss in the class when I'm discussing investment property. Okay. Then in that class, I will be explaining everything about the land, everything about the building, everything about the land and building both. Okay. Mostly in the next class. Okay. But tell me, is it clear the meaning, the recognition principle and the classification, everything, whatever I have discussed so far, is it clear everyone? If anyone has any queries, please discuss that with me. Okay. Is 12 months to be strictly to be followed? Yes, Vinod. Yes. Okay. Okay. Now moving forward, point number 3 is measurement principle. Or before I write point number 3, I write here: if any asset, don't write, just read. If any asset qualifies to be recognized in financial statements, okay, then at what value? At what value is a question. Now, to answer this, we have to study what? Measurement principle. The value at which asset is to be recognized in the books of account. If a cost is not directly available, is there any provision for fair value? No. As of now, I'll not answer it off. So please hold your query for some time. Okay. Please hold your query for some time. Might be in the next class, your query will get automatically answered. Okay. But please hold your query for some time. So on the basis of what I've discussed so far, your answer is no. But your actual answer for this will get answered in the next class, I believe. Okay, might be next or next to next. Now, so this is what I'm trying to say. If any asset, okay, basically now I'm saying a particular asset is there which qualifies to be a property, plant and equipment, and it qualifies the recognition principle as well, that meaning thereby that it will be recognized in the financial statements. Now comes the question, at what value? At what value will we recognize the assets in the financial statements? And this will be answered by the question, by the point of measurement principle. So here comes our next point, point number 3, that is measurement principle. Measurement principle. Now the measurement principle, when we study measurement principle, we have to study two things basically here. We have to study initial measurement principle, and we have to study subsequent measurement principle. Now, what is the difference between these two? Initial measurement principle means the measurement on the date of purchase. Subsequent means the measurement over the life of asset. Are you able to understand this one now? Are you able to understand this, guys? So we have to study the initial measurement principle, and we have to study the measurement principle that is subsequent, that is after the date of purchase but over the life of the asset. After the date of purchase but over the life of the asset. Just to explain you in a simple layman language, I will draw this line chart. Let's suppose there is any particular asset with a life of 5 years. With a life of 5 years. So this is the date of purchase. So this is called as initial measurement principle. Okay. Now the treatment that we will be giving subsequently to the date of purchase, the treatment which we will be giving subsequent to the date of purchase is called as subsequent measurement principle, and this is called as initial measurement principle. I hope that is clear to all of you. I hope that is clear to all of you, the difference between the initial measurement principle and the subsequent measurement principle. Now what I'll be doing is I will be discussing each of them one by one. Now point number 1 is initial measurement principle. Okay, guys, understand when after the class, when you, I will always recommend you to read the study text, okay, the workbook of BPP if you are referring, okay, please read that. But when you are reading the book, you will find that in the book there is very less information given. Okay, you'll find the PPE chapter is completed within 1 page or 1.5 pages. Okay, but the question comes up, many students ask me this question, then why are we studying in this much detail? Two reasons for that. First, your workbook assumes that you have all the prior information of ACCA FR paper. Okay, so it just eliminates the basic information. But I don't assume that. I assume that a student is coming from very scratch. So I'm starting everything from the scratch and teaching it off. Okay, first point. Second point, in the exam, the questions do come from these topics. Okay, so you are required to study these also. Okay, that's the reason. So please don't feel that I am teaching anything extra. No, I am teaching only what is relevant for the exams. Okay, it's just that I'm not following the book in the sequence that it has been given. I'm thinking from the exam perspective basically. I hope that is clear to all of you. Now, initial measurement on the date of purchase. So understand the standard says initially the asset on the date of purchase, the asset will be measured at its cost. Guys, I'm not getting any comments in the comment box. Are you guys there? Can you please comment, or is it hang? Just want to check. Fine. Thank you. Because it's technology, no? So you never know when it gets hanged, and I am like thinking that why the students are not responding. At its cost. Now comes the question, what is the meaning of the term cost? What is the meaning of the term cost? So let us understand the meaning of the term cost now. So cost means what? Cost means purchase price. Okay, purchase price. Cost means any directly attributable costs incurred to bring the asset in the location and condition intended by the management. Now further, okay, these are the three points of meaning of cost. Any purchase price, any non-refundable taxes, any directly attributable costs incurred to bring the asset in the location and condition intended by the management. Let me explain this point now. Now, understand, purchase price, I believe all of you are very much clear and I don't need to explain anything, but the purchase price is the price basically which we pay to purchase a particular asset. Now, non-refundable taxes means, let's suppose, I'll give you two situations, okay? I will give you two situations. Let's suppose recently I have purchased a laptop. I purchased a laptop paying rupees 80,000, okay? I purchased a laptop paying rupees 80,000 and I got the GST credit for that. Now tell me, what is my purchase price? 80,000. And what is the taxes? Is it refundable or non-refundable? Is it refundable or non-refundable? Tell me. Refundable for me, okay? So now what is the net price for me? 80,000 minus 18% of 80,000, right? Basically 1.18 basically divided by, right? So what is the net price? Can you tell me the net price? 18,000 divided by 1.18. Come on, guys, tell me the net price. I believe all of you are having calculator, right? Okay, 68,000, somewhere in the range of 68,000. Sunny said, okay, now, Sami, sorry. Now, so what happens? 68,000 is the price. So now what happens? If it is refundable, I am removing that part from the cost. If it is refundable, I am removing that part from the cost. But if it is non-refundable, let's suppose if one of you purchase it off, definitely okay, and if you are not eligible for a GST credit, if you are not eligible for a GST credit, so 80,000 is the price. Basically 12,000 paid as a tax will not be refundable to you, will not be refundable to you, and it will form part of the cost, right? So that's what it is being said here. Non-refundable taxes, if there is any, it will form part of the cost. Now I believe this and this is clear to all of you. Now comes the next point, any directly attributable cost. If there are any directly attributable cost incurred to bring the asset in the location or condition intended by the management. See guys, understand, in our lower classes, like for example class 12, or might be CA foundation, or might be ACCA knowledge level papers, we studied that okay, we have to capitalize the transportation cost, we have to capitalize the installation cost, or whatever costs are there, we have to capitalize all those things. But now IAS 16 summarizes all these costs in one point, which is any directly attributable costs incurred to bring the asset in the location and condition intended by the management. Now let's suppose I have the company has purchased a machinery, okay, from Delhi location, and it wants to use that machinery in Bangalore. Now tell me, don't you think he will incur the costs to bring the machinery from Delhi to Bangalore, right? Because the management intends to use the machinery in Bangalore location. The management intends to use the machinery in Bangalore location. So any cost incurred to bring the asset in the location and condition intended by the management, everything will get capitalized. Now let's suppose I purchased a laptop paying rupees 80,000, okay, but I want basically I want to do some modifications to the laptop, okay, I want some modifications in the laptop. It is only after that I can use the laptop. Let's suppose the modifications will cost rupees 12,000 extra, or let's suppose 15,000 extra. The modifications will cost rupees 15,000 extra. So what happens here, the price at which I will capitalize the laptop is not 80,000, rather it will become 95,000, because I don't want to use the laptop in this condition. I want to make some modifications to the laptop, and it is after that I will be using the laptop. Are you understanding this point? Right? So basically what happens, any costs incurred, okay, understand this word, understand this line properly, and you have to remember this line also in the exam. Any directly attributable costs incurred by the management to bring the asset in the location or condition intended by the management. Basically any cost incurred to bring in the location and to bring in the condition, any cost incurred till that date will be capitalized or will form part of the cost of the asset. Is that clear, everyone? Okay guys, just give me a minute, please. Just give me a minute. Yeah, I forgot to put my system on charge, so I just was doing that. Okay, now, so this is the meaning of cost at which the asset should be capitalized. But there are certain you can say exclusions from this cost. Let me explain those. Specific Now, let me explain these four costs. Advertising costs. Advertising costs. Now, basically, a standard says if you are incurring any amount in advertising, if you are incurring any amount in advertising, that will not form part of the cost. It will not form part of, it will not form part of cost. It will not form part of cost. Why? Why? Now tell me, understand the situation, guys. Let's suppose I am advertising about a particular asset. I am advertising about a particular asset. Okay, now understand, even though it qualifies to be a PPE, even though it qualifies to be, though it will not, but even though it qualifies to be a PPE. Okay, further, what is the recognition principle? That future economic benefits are probable. Now let's suppose I have advertised about our SBR classes. Okay, we advertised about our SBR classes. Is it certain that the students will come? Is it certain? No, it's not certain, right? It's not certain. Now still, now tell me, when we advertise, when we give advertisements, can we control the advertisements? Can we ask a customer, now you have to come? Can we control that? Can we control that? No, right? So that's the reason we cannot capitalize the advertising costs at any given point of time. Okay, now comes employee costs. Employee costs are of two types. One is salary costs and one is training costs. Now understand, I wanted to get an asset internally constructed. Okay, I wanted to get an asset internally constructed, and my employees helped me in the construction of that particular asset. Okay, my employees helped me in the construction of that particular asset, and I have given salary to them. So don't you think the salary which I have given to my employee, the salary which I have given to the employees for the services that I received from them in the nature of construction services should get capitalized? Tell me yes or no, because that is directly attributable to the in bringing the asset in the condition intended by the management, right? So it will be capitalized. It will form part of the cost. It will form part of the cost. It will form part of the cost. There is no challenge in that. Ekta, why do you think it's a no? Why do you think we will not capitalize the salary costs?
Sir, I
Why do you
thought
think
that
we will not
salary is
capitalize
fixed.
salary costs?
Can
take
you
up a
hear me,
real life
sir?
example. All the startup companies, they have a very large IT team, right? And this IT team helps them in the development of the application, the website, everything, right? They continue. Okay, now don't you think that do you think that their salary expenses will go to P&L? No. Why? Because their salary is paid to develop a application, to develop a mobile application, right? And hence all their salary will be capitalized as intangible asset. All their salary gets capitalized as an intangible asset. Even though the salary remains fixed only, right? Salary is fixed. His salary is fixed, but understand, we have to see what are we getting in return for the salary that we are giving. We are getting construction services. An asset is being developed for us. An asset is being developed for us, and hence it should get capitalized. Okay, now let's suppose there is an employee who performs day-to-day services. Okay, he just maintains the application. His salary will not get capitalized. His salary will be transferred to P&L. Okay, now cost capitalized provided, okay, he provides for development of an asset. Okay, now training cost. Now let's suppose the entity purchased a new machinery. And now what the entity wants, it wants to give a training to the employees on how to use the machinery. It wants to give a training to the employees on how to use the machinery. Now tell me, if I am giving the training to my employees on how to use the machinery, is it the case that the benefit which I've given to the employees, I will get all the future economic benefits from the employees? No. Why? Because on the very next day, the employees might resign. Right? So I will not be able to receive the benefits from them because I don't control my employees. I can't control my employees. And hence whatever is a training cost, it will not get capitalized. Is it clear, everyone? Okay. Yes, that can also be one of the reason, Hari. That's a very good reason that you're saying. Training is for operating the machine, okay, not for bringing the asset into existence. Very good. That's also one of the reasons. So basically, there can be n number of reasons. First reason is the future economic benefits are not certain. Basically, second point here is can be we don't control our employees. Third point is training is for operating the machine and not bringing into existence. Wonderful, wonderful, wonderful. This is what I want. Now, testing costs. Testing costs again can be of two types. Testing costs again can be of two types. One is in the nature of inspection. And another is in the nature of market survey. Now let me explain the meaning of both. Let's suppose for all the aircrafts, they are supposed to undergo an inspection every 5 years. Okay, if they have not gone under inspection, if they have not undergone the inspection, they cannot operate. So what happens? This testing cost is in the nature of inspection. Now what happens if we don't incur this inspection cost? We will not be able to realize the future economic benefits from the asset. Why? Because if I'm not incurring this inspection cost, the flight will not be allowed to operate. If the flight is not allowed to operate, I will not be getting the flight fares. I will not be able to sell the flight tickets, right? If I'm not able to sell the flight tickets, there is no revenue. No revenue means no future economic benefits, right? So what happens? Indirectly, this inspection cost gives us future economic benefits, and it is because of this reason it should form part of the cost. But if the cost is in the nature of market survey, let's suppose Reliance opened a park, okay, an amusement park for general public, okay, but what it did, before it became operational, it opened for the public for the first month, just to get a survey or just to get an opinion from the general public whether they are liking the park or not. And in this first 1 month, the park ticket is priced at 0 rupees, so that everyone will come and give their feedback, and accordingly we can operate the park. Now here also there is a testing cost involved, right? Why? Because the fees becomes 0. So this is a cost, right? Now this cost is in the nature of market survey, and it is like an advertisement cost. And hence it will not form part of the cost. I believe it is clear to everyone. Now I'm coming to that point now. We need the next point. Any benefit from testing costs. Okay, let's suppose if I'm testing a particular machinery, okay, a few products gets developed, and I sell that and realize some amount. Earlier, the standard used to say that deduct it from the cost of the asset, but now the standard says record it as a income. Do not deduct it from the cost. Okay, I'll come to it, Hari. Don't worry. That will be treated as part of subsequent treatment. Okay, not now. Understand first. Any benefit from testing costs will be treated as an income, but not as a deduction from the cost. Why? Because the standard setters are of the opinion, whenever you get a testing, whenever you are testing any product and there is any income from that, that there is a cost for that product, there is a revenue allotted for that product, treat it as a revenue and cost of sales. But if you deduct it from the cost, what happens? The actual cost is not reflected for that particular asset. Okay, the actual cost of that particular asset is not reflected and it gets distorted, and the amount of cost gets distorted. So keep the cost separate, and if any product gets developed in the process of testing, keep it separate. I hope that is clear to all of you. If it is derived from the nature of inspection, then it shall be derived from then it shall be continuous deduction. I didn't get your query, Vinod. Can you please repeat it once again? So basically what I'm trying to say here is, any product, if it gets developed from the testing phase, whether testing phase, okay, it should get we will record that as a revenue and cost of sales, rather than deducting it from the cost of the asset in any case scenario, whether it's inspection or whatever it is.
Can you hear me, sir?
Because the standard setters are of the opinion that if we reduce from the cost, the cost gets distorted and it doesn't reflect the actual costs. No, Vinod, you cannot be audible as of now. If you want to speak to me, you can do it at either the end of the class or after the class. You can you can have a call with me, or you can send a voice note. Okay, but in the class we cannot open my student for the. Okay, this one. Now I believe that is clear to all of you. Sorry. Tell me, guys, is it clear, everyone, till here? Is it clear, everyone, till here? Now comes painting costs. Now, painting cost generally is, you can say, it will be transferred to P&L. It will not form part of cost. But the standard says, if it is something which is incurred to bring the asset in the location or condition intended by the management, then yes, you can include this as part of the cost of the asset. To give an example, when you go to some cafeterias, or might be to some hotels, you will find very expensive paintings there, right? You can find very expensive paintings there. See, now the painting are of two types. One, just the normal wall painting. Okay, now the another is exclusive painting. Okay, either painted on the wall or as a, you can say another a memento sort of thing. Okay, basically a painting purchased and hanged on the wall. Now that can be capitalized. Okay, if there is something specific, which enhances the, you can say, the beauty of the space, yes, you can capitalize that. Is it clear, everyone? Now, I am taking one more point here in the initial measurement itself. Okay, let me write here. Now, understand what I'm trying to say here is, initial measurement means two things. One, the costs incurred on the date of purchase, that we discussed right now. Now it also includes if I am incurring any cost subsequent to date of purchase. If I am incurring any cost subsequent to date of purchase, that is over the life of the asset, if I am incurring any cost, that is also covered under initial measurement. Because see, understand, initial measurement means what? The date when any cost is being incurred. After the date of incurring any cost, the treatment for that is called as subsequent treatment. Okay, but here it is called as initial measurement itself. By painting, the asset enhances, then also it gets capitalized, that is by painting as part of the testing and maintenance. I'll come to this point thus. Okay, I'll come to this point here itself. Now it says, if you are incurring any further costs, we have to see whether it is for repairs and maintenance. Okay, whether it is for replacement or whether it is for inspection. Now understand, repairs and maintenance means what? Tell me. So basically what happens here, what I'm trying to say, thus your query will get answered here. Okay, so first, any painting costs which I am incurring on the initial date, that is on the date of purchase. Let's suppose I purchased a building and I'm getting it painted, definitely it will get capitalized. Why? Because that is an initial measurement date, and whatever cost I incurred to bring in the condition of using it, I will capitalize everything. Whether transportation cost, installation cost, painting cost, or any interior works cost, I will capitalize everything. But if I am incurring any painting cost or repair cost or maintenance cost or inspection cost or replacement cost subsequent to the date of purchase, the treatment we have to understand. Again, we are required to assess whether it satisfies the recognition principle or not. Now tell me, if going forward I am incurring any repairs cost or maintenance cost, is it increasing the future economic benefits? No, right? So it is not to be capitalized, rather it has to be transferred to P&L, because it just maintains the asset. Repairs and maintenance cost, as the name says, it just maintains the asset. Okay, it just maintains the asset. Now let's suppose you are replacing one of the components of the asset. So what happens here, when you replace a component, you de-recognize the old component and recognize the new component. Is it clear, everyone? Whenever you replace any component, you de-recognize the old component and recognize the new component. Now, inspection. If you are incurring any inspection cost, like for example, I took the example of aircraft, right? So again, it has to be from capitalized to the asset. Is it clear, everyone? That completes our discussion on the initial measurement. But please confirm, is it clear, everyone? Okay, fair enough. Now, moving on to the next topic, that is subsequent measurement, point number 3, subpoint 2. Point number 3, subpoint 2. Subpoint 2. But before that, what I'll do is I will take a break of 20 minutes and then we'll resume back at 11. Subsequent treatment. Now, we'll break here for 20 minutes and we'll start at sharp 11 a.m. Okay. If it's a major repair that will increase the life of the asset, will it be capitalized? Yes. Yes, it will be capitalized in that case. For example, let me give you an example. Basically, if there is any expenses, okay, which increases the you can say capacity of the asset. Like for example, there is a movie hall which had 100 sitting arrangements. Okay, now I did some major renewals, okay, or basically major repairs, and now after that repairs, the sitting capacity increased from 100 to 150. Now basically it becomes what? We have to capitalize this cost. Why? Because there will be a future economic benefit from that. Okay. Now, Satish has a query. If it's a regular inspection, the inspection which I'm talking is a regular inspection. But you have to understand this inspection which we are doing is an enabler asset. It is an enabler asset, meaning thereby, if we are not doing this inspection, we will not be able to operate the asset, and hence it has to get capitalized. Okay. Okay, thus in that case, again, the printing cost will get capitalized in this case. Okay. Now, okay, fine, no worries. Inspection costs. Where exactly it is? It says if this inspection cost is an enabler asset, now what is the meaning of an enabler asset? Meaning thereby, if I'm not incurring these expenses, I will not be able to operate the asset. Okay, I will not be able to operate the asset. Meaning thereby, for example, take the example of aircraft. Okay, so it has to go for a mandatory inspection of the flight for every 5 years, and it takes around 4 or 5 crores rupees of an amount to inspect, right? So now when you are incurring such a big amount on inspecting a particular asset for every 5 years, the standard says we have to capitalize it. We have to capitalize this amount and amortize over the 5 years, because again, after 5 years, we have to incur this inspection costs. Clear, Vinit? Okay, now here what I'm discussing is not subsequent measurement, it is subsequent costs. I didn't discuss subsequent measurement here. I just discussed subsequent costs and initial cost. It is still under initial measurement. No, again, what I told, it's enabler. If it is not mandatory, then it's not to be capitalized. Okay, then we think that it is just for maintaining the asset. Okay, it's not an enabler asset in that case. Now again, one more point is mandatory or not mandatory. It depends upon two things: legal obligation or constructive obligation. What is the meaning? If legal, there is a law that you have to get it operated, get it inspected after every 5 years. That's a law. So it's mandatory by law. Now, if it's a policy, it's not mandatory by law. Law nowhere states that, but it's a policy of the company that I will not operate a flight if it doesn't get inspected after every 5 years. then that's called as a constructive obligation. Okay, in both the cases we say it is a mandatory. Okay, we say it is mandatory in both the cases. Now let's take a break and we'll still resume at 11. Okay, let's resume back. Is it from break, guys? Can you please confirm? Okay. Now, so far, what we discussed was from initial measurement perspective, and just to draw the chart for that. So, as I told that the measurement principle which we study, the measurement principle which we study, we have to study two things from that perspective. One is initial measurement, and one is subsequent measurement. Okay, now in initial measurement, we studied about again two things: initial costs, that is on date of purchase, and any subsequent costs if we incur, what is the treatment for that. Now, what we have to study is subsequent measurement, and the standard says that subsequently an asset can be measured as per two cases, that is cost model or what's next? Tell me, guys. At least you can tell me the name. I believe all of you are aware of it, the name. Cost model or what? Revaluation model. Very good. Cost model or revaluation model. Okay, is it clear, everyone? Now we have to study about these two models in detail now. Ready for that? Let's start. So first we have to study important points. Few important points. For subsequent measurement. Let me write that. The choice between cost model and revaluation model, the choice between cost model and revaluation model is available on class by class basis. Now, what is the meaning of class by class basis? And let me write it further, and not on asset basis. What is the meaning of class? So basically, if you have seen any financial statements, you will find that whenever we prepare a property, plant and equipment schedule, we give the bifurcation of the PPE on a class basis, right? That this is a land, this is a building, this is, you can say, office building, this is factory building. Okay, this is office equipments, this is electrical fittings, this is furniture fittings, right? Is it okay? This is electrical fittings, this is furnitures and fixtures. Okay, now, so these are called class. And now comes the question, how is class determined? So to answer that, class is determined on the basis of use, purpose, nature. Okay, so use, purpose, or nature. On the basis of these, we classify the asset into different classes. Are we required to determine class in the exam? No, the class will be given in the exam. But now understand, the standard says that whenever you have to determine whether you have to follow cost model or revaluation model, you have to determine on a class by class basis and not on an asset by asset basis. What is the meaning of this one? Let me explain that. Let's suppose any entity has three class of assets. One is, let's suppose, building, okay, office buildings, not a building, office building. Office building. One is factory building. One is office equipments. Now, under office building, it has office building number 1, office building number 2, office building number 3, office building number 4. In factory building, again, factory building number 1, factory building number 2, factory building number 3. In office equipment, again, office equipment number 1, office equipment number 2, office equipment number 3, office equipment number 4, office equipment number 5. These are particular assets. And these are a class of assets. Now, this is a class. This is one class. This is one class. And this is one class. Now, what the standard says is you have to determine whether you have to follow cost model or revaluation model for each class. Let's suppose the entity determines that I will be following cost model for this one. I will be following cost model for office building. Now, can it be the case that one particular office equipment is recorded at revaluation model? Can it be the case? Tell me, guys. No, right? Similarly, if the entity determines that factory building will also be at cost model, can I record one particular office factory building at revaluation model? No. If I determine the office building will be as per revaluation model, can I determine any one specific building at cost model? No. So this is what it wants to say. Is it clear, everyone? First point. Is it clear, everyone? First point. Now, second point. The choice between cost model and revaluation model is available on a class by class basis. Okay, now second point. If entity opts for revaluation model, the frequency of revaluation should be once in every 3 to 4 years. It's not that I will revalue it every year, but it's like we have to revalue every 3 or 4, once in every 3-4 years. Okay, that is the practice that we have to follow. But standard again goes on to state that if the fair value of any particular asset is highly volatile, then revalue every year. Is it clear, everyone? Then in that case, we have to revalue every year. Is it clear, everyone? Come on, guys, tell me. I don't think so. There is anything to explain in this case. This self-explanatory points. These are self-explanatory points. Now. So this is what I have discussed. This one I have discussed some important points for subsequent measurement. Now what I want to discuss is how will we revalue under cost model and how will we revalue under revaluation model. Okay, let me discuss that. Under cost model. Under cost model. We record the asset at each reporting date. At each reporting date, PPE is recorded at original cost minus accumulated depreciation, okay, minus accumulated impairment loss, if any. To give an example of it, though it is not required, I believe, but still let me give it off. Let's suppose I purchased an asset at $100. I purchased an asset for $100, the life of which is 5 years. I purchased an asset at $100 and the life of which is 5 years. So what I will do, or let's suppose that life is 4 years. Okay, life is 4 years. Manasa is asking me to scroll to last point. Yes, please. Is this point you are trying to make? I have zoomed out. You can, if you want to write, you can write it off. Let me know once it is done. No, Satish, there is no guideline for highly volatile. That's judgment. That's a judgment. Okay, now if there is an asset for $100, the life is 4 years. Now tell me what is the depreciation for this year? $25. So what happens? So here the asset will be recorded at $100 minus 25, that is $75. Now here the depreciation is again 25. So asset will be recorded at 100 minus accumulated depreciation, that is depreciation for all the past years, that is $50 equals to $50 is the carrying amount of the asset. Now again this year the depreciation is 25, so it will be recorded 100 minus 75 equals to $25, and here again the depreciation becomes 25, so it will be recorded at 0 value. Okay, so that's what is called as the cost model, which is very simple, which is very simple, right? Which is very simple. Is it clear, everyone? Is it clear, everyone? Okay, now there cannot be any specific example for a highly volatile asset. I don't know okay, it's just a number given. Okay, now so I'm saying there cannot be any specific example. It says if there are any, though I cannot think of any example where the fair value becomes very highly volatile. Okay, though there are multiple examples, but that doesn't qualify to be a property, plant and equipment. Okay, now so that's what is a general rule given, that we have to revalue every once in 2 to 3 years or 3 to 4 years. But if it is very highly volatile, it might be the case that we have to value it every year. Now further, under revaluation model, Now, what is given here is a fair value of PPE minus any subsequent accumulated depreciation minus any subsequent accumulated impairment loss. Here we need to understand the meaning of the term subsequent. Let me explain that also. The only word important here is subsequent. Only word important here is subsequent. Let me explain the meaning of it. Let's suppose there is any particular asset. I'll continue with my previous example. Let's suppose there is a asset costing $100. Life is 4 years. Life is 4 years. Now at the end of first year, depreciation is 25. So I will record the asset at 75. At the end of second year, the depreciation is again 25. So I will record it at 50. Now let's suppose here the fair value is, let's suppose, 60. So what will happen? I will have a revaluation gain of $10. Now what will happen? Any subsequent, so this will become the revised carrying amount. So your revised carrying amount will be equals to 60. Your remaining life will be equals to 2 years. Hence your depreciation per year will become how much? 30. So at the end of first year, what you will do is it is 30. So now when you are calculating the carrying amount of the asset, rather than taking 25 plus 25 plus 30, that is 75, 80, that is 80. Rather than taking accumulated depreciation as 80, I will take 60 minus 30 is equals to 30, right? See here what I did. See here, 75 means 25, 25, 25, but here 30 means only this 30. That's the reason, because this was the date of revaluation. Subsequent means what? Hence subsequent means what? Subsequent to date of revaluation. Subsequent to date of revaluation. Is it clear, everyone? Is it clear, everyone? Is it clear, everyone? Come on, guys, tell me, is it clear, everyone? No, fair enough. So that's the second point under the revaluation model. Now, what I'll do is I will take point number 4. Point number 4. Before that, I will go to the content. See, in content, we discussed today the meaning of property, plant, equipment. We discussed the meaning of recognition principle. We discussed the meaning of measurement principle. We discussed the important points now. Right now, we have to discuss the treatment of revaluation gain or loss and the treatment of revaluation reserve. So this becomes my fourth point. That is treatment of revaluation gain or loss. Now, before I start the discussion of it, you have to tell me, whenever there is a revaluation gain or a loss, where does it get accounted to? Tell me. Revaluation reserve or revaluation surplus? Very good. Revaluation reserve or revaluation surplus, same thing only. Okay. Now, where does this revaluation surplus gets accounted for? Loss is impairment loss. No, Vinith, impairment loss is something different. Okay, I'll explain the difference also, but this loss is not an impairment loss. This is something different. Okay, I'll explain the meaning. Don't worry at all about it. Now, first tell me, this revaluation surplus or the revaluation gain or revaluation loss goes to other comprehensive income. In short, we call it as OCI. We say it as OCI, and from here it gets transferred to other components of equity, that is called as other equity, right? That is, in layman terms, we say it is a reserves and surplus, right? It is transferred there. Is it clear, everyone? Is it clear, everyone? Vinith, I am parking your query for some time, might be today or in tomorrow. I'll take up your query, okay? But your query will get answered in detail in the standard of IAS 36. But still, I'll take up your query either today or tomorrow. Don't worry at all about it. Now, this is your revaluation gain or loss. But now understand. Let's suppose you have an asset, okay, and you are revaluing it for the first time. Okay, it might be a case that you can get a revaluation either gain or a revaluation loss. Agree? It can be either of them. It can be revaluation gain or it can be a revaluation loss. We'll go step by step. I'll take a scenario first. We get if it is a case of revaluation gain. If it is a revaluation gain, tell me where will we transfer the revaluation? Okay, or let me do one thing. I'll make a chart. First time. First revaluation. You can have either revaluation gain or you can have either revaluation loss. Agree? Now, what you have to do is if it is a revaluation gain, definitely you will transfer the amount to revaluation. You will transfer the amount to revaluation. Tell me reserve, right? We'll transfer the amount to revaluation reserve. But now understand, if it is a revaluation loss, can we create negative reserve? No, we cannot create negative reserve, right? Basically, whenever there is a revaluation reserve, we have to adjust from the revaluation reserve. Whenever there is a revaluation loss, we have to adjust it from the revaluation reserve. But we can adjust only if there is a reserve created for it. What if it's for the first time? Means there is no reserve already created. So in this case, I will transfer it to P and L. Okay, we will transfer it to P and L. But understand in this overall treatment, and please understand this point, in this overall treatment of revaluation gain or loss. Okay, please listen to this line very carefully. This line will help you in the overall treatment of revaluation gain or loss. Okay, in this overall treatment of revaluation gain or loss, if you are transferring anything to the P&L, either a loss or a profit, if you're transferring anything to the P&L, either a loss or a profit, treat it as a loan to P&L. Okay, because we cannot record either a gain or a loss to P&L. If we are transferring it to P&L, that is temporary. Always have this in the mind. Okay, that whenever I am transferring revaluation gain or loss to P&L, that is temporary and I have to repay it back to P&L. Okay, if I have taken a loan from P&L, I have to repay it back. Basically, if I have transferred a loss to P&L, I have to transfer a profit also to P&L to adjust this one. Is it clear? Is this logic clear now? Now, if you have this logic in mind, you will be able to answer everything. Now, subsequent revaluation. Revaluation. When you are doing subsequent revaluation, you can have either a revaluation gain or a revaluation loss. Now, if it is a revaluation gain, again, you will transfer the whole amount to revaluation reserve. Tell me clear, because earlier also gain, so revaluation reserve, now also gain, to transfer, keep on accumulating it to revaluation reserve. Tell me yes or no. But if it is a loss, so what will you do? You will adjust the loss with revaluation reserve, right? Adjust the loss with revaluation reserve. Tell me yes or no. Now any excess loss is transferred where? Tell me. Any excess loss will be transferred where? P&L. Wonderful. Now if I'm transferring any excess loss to P&L, again subsequently if I am doing a revaluation and there is a revaluation gain, will I transfer that revaluation gain to revaluation reserve? No. First of all, I will transfer the revaluation profit or the revaluation gain to the P&L to the extent loss was transferred to P&L. To the extent loss was transferred to the P&L, and any excess will be transferred to revaluation reserve. Very good, Ayushi. Now here, revaluation loss initially got transferred to P&L. Now subsequent, subsequently it can be either a revaluation gain, or it can be a revaluation loss. Now simple. Earlier also revaluation loss, now also revaluation loss. So earlier also transferred to P&L, now also I'll transfer to P&L. That is simple. I'll zoom out, but please let me write it off, Mansa. Please let me explain this point, then I'll zoom out. Now tell me, earlier also revaluation loss, now also revaluation loss. So earlier also transfer to P&L, now also will transfer to P&L. Clear? But earlier revaluation loss, but now revaluation gain. So what you will do here? First of all, transfer revaluation gain to P&L to the extent loss was transferred to P&L. Now any excess will be transferred to revaluation reserve. Please make yourself comfortable with this treatment of revaluation gain or loss. Please make yourself comfortable with this treatment of revaluation gain or loss, and tell me if you have any queries. Is it clear, everyone? Any initial revaluation gain, at initial revaluation gain, the amount will move from to reserve via OCI or directly via OCI. Whenever we are creating any revaluation gain or loss, if it has to be registered with revaluation reserve, it will first go to OCI, then to reserve, not directly. Yes. No, it's not about no. I think you are getting me wrong. Anything you are transferring to OCI gets transferred to other equity, right? So it's not that you will make an OCI ledger. So you will say first I have revaluation gain, then you are showing a transfer from OCI to reserve. No, it's not like that. Like the way profit gets transferred to retained earnings, similarly OCI gets transferred to other components of equity, right? So in the statement of profit, do you say a negative profit that is transferred to retained earnings? No, right? So profit automatically gets recorded in retained earnings. So other comprehensive income also automatically gets recorded in other components of equity. Exactly. Scroll left. There's nothing in the left. Is it clear, everyone? Is it clear, everyone, till here? Fair enough. Can we move ahead, guys? Can we move ahead? Next topic. Okay, fine. Point number 5. This is a point where I have seen students making mistake n number of times. Even if I've explained this topic to, even if I'll explain this topic n number of time, still you will make a mistake in n+1 time. So be careful. Treatment of revaluation surplus or revaluation reserve, both are same thing. Okay, or reserve, I'll write here. What is the treatment for the revaluation surplus or the revaluation reserve? All of us know that the revaluation surplus or the revaluation reserve gets transferred. All of us know that the revaluation surplus or the revaluation reserve gets transferred to retained earnings. Okay, ultimately it gets transferred to retained earnings, right? But the process is different. The process is there are two options available, but basically there are two options available. There are two options available. Option number A and option number B. I'm writing here or. First one, A, is a default option. Is a default option means if the question is silent, you will have to assume this one is a default option. What it says is transfer revaluation reserve to retained earnings at the time of disposal of asset. When the asset is disposed of, you will transfer the revaluation reserve to retained earnings. I hope this was clear to all of you previously also. You were aware of it, right? Because when we dispose of the asset, we clear the whole of the accounts. So what we do, if there is any revaluation reserve, we transfer that to the retained earnings, right? And close it off. Is it clear, everyone, till here? Is it clear, everyone, till here? But now option number B, you have to follow this only if specifically mentioned in the question. Specifically mentioned in the question. Only if it is specifically mentioned in the question. Now it says transfer revaluation reserve to retained earnings over the remaining life of the asset, over the remaining life of the asset. Is it clear? Is it clear? Right. So now basically it says you have to transfer the revaluation reserve to retained earnings over the remaining life of the asset. Let me explain both the options by the help of an example. Let's suppose we have purchased an asset costing $100 and the life is 5 years and the life is 5 years. So let me divide it into 5 years. 1, 2, 3, 4, and 5. Now it is here the carrying amount is, let's suppose $80 and I have did a fair value here. I did a fair value here, and the fair value, let's suppose, is dollar 90. Yeah, $90. Okay. So now what happens here? There is a revaluation gain of $10. Revaluation gain of $10. Right? That's what happens. Tell me yes or no. So it will be transferred. Definitely, this revaluation gain of $10 will be transferred where? To revaluation reserve $10. Clear everyone till here? Come on, guys, tell me. Now what happens under option number 1? I will transfer this revaluation reserve to retained earnings here. 10. I will transfer here. I will transfer here. Okay, on the date of disposal. Now what happens? It happens under option number A. This option happens under option number A. Okay, transfer at the time of disposal of the asset. Under option number B, what you do is you transfer a portion year on year. So what, tell me, what is the remaining life? 4 years. What is the revaluation gain? 10. So 10 by 4 is 2.5. So you transfer to retained earnings every year 2.5, 2.5, 2.5, 2.5. So this is what you are doing. This is option number B. Is it clear, everyone? Is it clear, everyone? So now, how a examiner plays with you? Is it excess depreciation? Yes, you can say also that is an excess depreciation, but don't link it with this one. Don't link it with this one. I have to explain 2 points here. Let me explain that, and then I'll take up all your queries. Okay. But for the time being, if you have any query, please keep on writing it off here, but I will not be taking it off. Okay. But let me explain the 2 points first. First point, understand how the examiner will test your knowledge in this one. Examiner, Satish, okay, now understand how the examiner will test your knowledge. So examiner will say the entity has a policy. The entity has a policy of transferring the revaluation reserve to retained earnings over the life of the asset. Okay. Now you had a revaluation gain of $10. So now here, you have a revaluation gain, a revaluation reserve, a balance of which is 2.5, and now you have a revaluation loss of 5 or 4. You have a revaluation loss of 4. Now where a student will make a mistake, he will think, oh, I had a revaluation reserve of 10, I have a revaluation loss of 4, so I can, this 4 I can totally adjust here, and the revaluation reserve balance will be 6. But now understand, you have to think that the remaining balance of revaluation reserve is only 2.5. So you have to transfer the excess 1.5 to P&L. So this is how an examiner will try to confuse you. So please make a note of that. Okay. Now in case B, if there is a revaluation loss of 4 here, so out of 4, 2.5 will be adjusted with revaluation reserve, and the remaining 1.5 will be transferred to P&L. Is this point clear to all of you? Is this point clear to all of you? Is this point clear to all of you? Now, second point. Tell me, due to this fair valuation exercise, what is the depreciation? What is the revised depreciation? 22.5. Right? And prior to this depreciation, prior to this fair valuation, what was the depreciation? 20. What is the difference between these two? 2.5. Meaning thereby in the P&L you are charging an excess depreciation of 2.5, which you are transferring to retained earnings every year. Though there is no linkage between the two, okay, there is no linkage between the two, but there are few standard setters who are of the opinion that this method of transferring at the year end, transferring on every year is more logical. Why? Because when we are charging excess depreciation, listen to me carefully, when we are charging excess depreciation means my profitability gets reduced. Means it has an impact on the retained earnings. It reduces my retained earnings. Now if it reduces my retained earnings every year by 2.5, so now if I transfer the revaluation reserve to retained earnings 2.5 at every year end, it will match the account. It will keep my retained earnings intact. That's what is the assumption or the notion of the standard setters. Is that clear, everyone? In a nutshell, we are keeping depreciation indirectly. We need understand there is no nutshell for this topic. I'll say for this topic specifically, there is no nutshell. Okay, the P&L gets impacted by the fair valuation. The P&L gets impacted by the fair valuation in a normal manner. Nothing to do with this treatment of revaluation reserve. Nothing to do with the treatment of revaluation reserve. Meaning thereby, with this treatment of revaluation reserve, there is no different impact on the P&L. Okay, because if we transfer the revaluation reserve to retained earnings at the time of disposal or over the life, doesn't matter at all. Okay, P&L doesn't change at all. Okay, P&L doesn't change at all if we choose A or B. What changes is the retained earnings. What changes is the retained earnings. Is this an amendment? No, this is not an amendment. What changes is the retained earnings. You see, no worries, I'll explain it again. What I was trying to explain here is, let's suppose I have an asset having a value of $100. The life is 5 years. So every year we'll charge a depreciation of 100 by 5, 20 per year. Okay. So in the first year, I charge depreciation of $20. And at the year end 1, I had a carrying amount of $80. Now I planned to revalue my asset. And the fair value is 90. So there is a revaluation gain of $10. Right? This revaluation gain of $10, I will transfer to revaluation reserve. Clear till here, IOC? Is it clear till here? Now, when I transfer this revaluation gain to revaluation reserve, now I have two options. Option number 1, I will transfer this revaluation reserve to retained earnings after at the time of disposal of the asset. Okay, now, meaning thereby here at the year end 4, still I will have a revaluation reserve of $10. Okay, but if I follow option number B, I will have to transfer the revaluation reserve over the remaining life of the asset. That is, $10 has to be transferred to retained earnings over 4 years. Now what happens when you transfer the $10 to retained earnings over 4 years? What happens here is you transfer 10 by 4, that is 2.5 every year to retained earnings. Now when you're transferring this, so at the year end 4, what will happen? 2, 3 and 4. For the 3 years, you would have already transferred. To retained earnings. So what is the balance remaining here? 2.5, 10 minus for the 3 years it is already transferred. So the balance remaining in retained revaluation reserve is only 2.5. Now let's suppose at the year end 4, again I do the fair valuation exercise. So when I'm doing a fair valuation exercise again on year end 4, I get a revaluation loss of, let's suppose, $4. Right? Now, if I am following option number B, I have a balance in revaluation reserve of 2.5, but I have a revaluation loss of $4. So what I will do, out of 4, I can adjust with revaluation reserve to the extent of 2.5 only, and any differential will be transferred to P&L. Is it clear now, IOC? The amount of excess depreciation from the revaluation is to be charged against the revaluation reserve. Tanya is saying option A. If we follow option A, yes, if you follow option A, you will have a balance of 10. You will have a balance of 10 here, right? You will have a balance of 10 here, and you can charge this $4, entire $4 from this one itself. Okay, now let me understand the query of Vinod. Basically, Vinod has a query that previously till 2017, the amount of excess of the depreciation, that is 2.5 from the revaluation, is to be charged against the revaluation reserve. No, Vinod, this was not the case at any given point of time. You can please revisit the standards. Okay, you cannot charge the excess depreciation from the revaluation reserve. No, you cannot do that. Okay, please revisit the standards. And this is not an amendment. This was from the very beginning. And the choice of option A or option B is the company's policy. Okay. I hope that is clear to everyone till here. Yes, Naveen, sort of you can say, sort of you can say. Okay. Wonderful. So that's the treatment of revaluation surplus. Is it clear, everyone till here? Can we move on to the next topic, guys? Can we move on to the next topic? Wonderful. Point number 6. Specific assets. Now, so let us discuss the specific assets now. Point number is 6. What do you understand by deferred credit terms? Can anyone answer? What do you understand by the term deferred credit? Purchase today, pay in a future date. Can you give a real life example for such purchases? Purchased on dash model. Example can be right. Purchase on EMI or EAI model, equal monthly installments or equal annual installments. Very good, Krutarth, Kannan, Kushagr. Okay, all these Ayushi, everything is all of you are correct in this. All of you are correct. Now, the question is, how will we account for this one? How will we account for this one? So basically, the standard says that you have to record PPE at its cash price, means the price which I have to pay if I will pay the price right now. If I will pay the price right now. And the standard says how to calculate the cash price. How to calculate the cash price? I have to calculate it at present value of the deferred terms. Present value of the deferred terms, meaning thereby, let's suppose if I am paying in the future, if I'm paying in the future, so I have to calculate the present value of it and record it. To give an example of it, let's suppose I have purchased an asset, okay, which okay, but I will pay 1 lakh or 100,000. I'll write here, I'll pay 100,000 here, and here, okay. And the rate of interest, the discount rate is 10% per annum. So question is, at what value you will record the asset now? So you will record the asset account debit to liability, the amount. Can you please calculate the present value of this one? Can you please calculate the present value of this one? It will not be 363, it will be something different. Not for 4 years, it is for 3 years. Kannan, it is for 3 years. It will be 248 something, 248 688 if I'm not wrong. Can you please check this number? 688 or 868, something in that range only. Please, can you please calculate it off? I think you can do that calculation. So now it is in this manner you have to record the asset. You have to record the asset. Okay, it will not be 225, definitely not. Okay, definitely not. 10% if you calculate, it will not be 240. Okay, 248 8688. Yeah, this, it means this is correct. This is correct. Now subsequently what will we do? Subsequently I will amortize, or not amortize, I will write here depreciate the asset over its useful life, I will depreciate the asset over its useful life. This liability is becomes like a financial liability to be amortized over 3 years. Over 3 years. How exactly? I will show that also. Don't worry. Now, I will prepare an amortization schedule. Year opening liability plus year opening liability, finance cost, payments, closing liability. Right, so year one, total liability that I have recorded is 2488688. 248,688. Finance cost at the rate of 10% is 24868. Payment, we have done a payment of 100,000. Right, so closing liability, can you please calculate? Please calculate the closing liability. It will be something in the 173,355, I believe, but still confirm the exact amount. 173,555. Second, 173,556. Amount is 173,555. Payment is again 100,000. Right, so this is 90,901 if I'm not wrong. Okay, third one is year 3 is 90,901. Finance cost is 9,090. Okay, now payment is 100,000. So this becomes nil. This finance cost will go to P&L. This payment will go to statement of cash flow. This closing liability will go to balance sheet or statement of financial position. Will go to statement of financial position. Okay, as financial liability. It is payment to the payment for the purchase of asset. Payment for the purchase of the asset. Is that clear, everyone? Is that clear, everyone? So this is how we account for the purchase of an asset on deferred credit terms. Is it clear, everyone? Okay, so basically, rather than taking the whole amount of 3 lakh as the cost, I have to remove the finance component, finance cost component. I have to remove the finance cost component of it and then capitalize it. So what I'm doing, I am recording 3 lakh minus this one as my asset. Okay, 3 lakh minus the finance cost, I am recording as my asset. Okay, so this is 3 lakhs. Now, can you please calculate the total finance cost? Can you please calculate this total? Can you please calculate the total of this one? Please calculate the total of this one. All three, 24868 plus 17355 plus 9090. Total is 51313. 51313. Now, asset will be recorded at 3 lakhs minus 51313. This will be in the range of 248,687 or 686, something in that range. Is it clear, everyone? right? So this is how we record the asset on a deferred credit terms. Is it clear? Now the next is provision for decommissioning cost. If I'm not wrong, just let me see the content also. So I've discussed this one. I will discuss the provision for dismantling cost, and this will be the last topic for today. This will be the last topic for today. Tomorrow, in the next class, we will be discussing the remaining topics of PPE, and the I will complete the intangible assets and investment property also tomorrow. The next point is provision for dismantling costs. Dismantling or decommission or restoration costs. Understand this topic. This is a very important topic. From might not be from an exam perspective, but definitely yes, from a practical perspective. Now what happens? Well, I believe all of you are aware of this term. First and foremost thing, I believe that all of you are aware of this provision for dismantling, decommissioning, or restoration costs. But I don't want to discuss the calculation of this also. Okay, though I will discuss, but I don't want to. But rather, I want to discuss the meaning, why we calculate this and how we calculate this. Okay, understand all of you. Come on. Okay, before I explain, can you tell me what is the meaning of this one? Provision for dismantling, decommissioning, and restoration costs. What is the meaning that you understand? What is the meaning that you understand? Removal of asset at the end of the life of the asset. Okay, fine. Anything else? Anything else? Come on, guys, please answer. Whether right or wrong doesn't matter, but please answer, all of you. So if there are 24 students in the class, I want whenever I ask any question, there should be 24 comments in the chat box. Okay, a removal of asset at the life, removal of old asset and installing new asset. Okay, no Ravi. Future obligation for dismantling an asset at the end of the life. Very good, Satish. Restoring the land to original condition. Very good, Manasa. Okay, costs incurred to restore to working condition. Okay, Mansa is my old student. She was in my FR batch also, right? So she knows what I'm trying to say here. She already knows it. Okay, now understand. So basically what happens is, let's suppose this is the life of the asset. This is the life of the asset. Okay, this is the purchase date. Let's suppose the life is 50 years. The life is 50 years. The life is 50 years. Now what happens at the life, not so, and you are using the asset at a particular place. So what will happen? This place where you are using the asset, definitely will get damaged or destroyed. Okay. Now when you are vacating that place, you have to restore the place. Okay. Now to give an example, why there is an obligation to restore the place. If you are aware of it, there is an asset called as oil rig, okay, which gets installed on the ocean waters, which extracts the petroleum from the sea bed, Now what happens? And that the life is generally 50 years or 70 years for each oil rig, okay, or might be 30 years also in some cases. Now understand, if from one particular place, or the petroleum will get extracted for continuous 30 years or 50 years or 70 years, don't you think that area of the sea, that area of the ocean will get damaged? The seabed will get damaged. There will be a lack of minerals there. Don't you think so? Now the government says that I will give you approval to install a oil rig at that place in the ocean only if you will restore the place once you are once you are removing the asset from there. Okay, once you are removing the asset from there, you have to restore that place, meaning thereby you have an obligation to restore that place. That is called as restoration cost. That is called as restoration costs. Now there are certain big assets like oil rigs. Again, they are very big, they are very huge, so definitely I cannot go and lift the oil rig and get it installed there. No, I have to take it in a dismantled form and then install it there. And now once I have to remove the oil rig from their place, I have to decommission each and every part and dismantle it off. And this dismantling also requires a huge amount of expenditure. Now tell me, can I utilize the benefit of oil rig? Please listen to my question carefully and answer it off. Okay, now I don't want any wrong answers here in this question. I don't want any wrong answers now, because I've already explained this point. Can I recognize the, okay, or can I avail the benefit of oil rigs? Can I avail the benefit from the oil rigs without incurring the restoration cost or decommissioning cost or dismantling cost? Can I avail the benefit of it? No. Meaning thereby this acts as an enabler asset. Can I say? Though directly dismantling or decommissioning or restoration cost doesn't have any future economic benefits, they are not satisfying the recognition principle, but they enable these expenses enable the overall asset to generate future economic benefit. Because if I will not take an obligation for these costs, I will not be able to operate the asset itself, right? So it becomes an enabler asset. It becomes an enabler asset, and hence we have to capitalize it. That is for sure that I have to capitalize it. But now the question that comes up, tell me when we will incur this cost. I will incur this cost here, right? I will incur this cost here. But now when are we capitalizing the asset? The asset gets capitalized here, right? The asset gets capitalized here. So now, okay, yes, that's what I don't want. So everyone is saying now, Kannan, Manasa and IOC, all of you are telling, please take the present value. No, I will not take the present value. The standard says that, and there is a misconception among the students. Students think that I will estimate the cost that will be incurred here. Tell me, can you estimate some cost that will be incurred after 50 years? Can you estimate any cost which will be incurred after 50 years? No, we cannot. So if you are not able to estimate the cost which will be incurred after 50 years, how can you calculate the present value of that? So what I will do is, I will estimate the cost here. I will estimate the costs here. That if I will do the decommissioning or dismantling or restoration, what will be the cost as on today's date? What will be the cost as on today's date? Can I estimate this one? Tell me, can I estimate this one? Right? Now what I do is, I take this estimate to a future date, that is after 50 years, by using what? Inflation rate in the country. Okay, by basically adjusting this amount for the inflation. Now let's suppose the estimate was $100. The estimate was $100, and by adjusting the inflation for 50 years, it becomes, let's suppose, 450. For 50 years, if I adjust the inflation, let's suppose it becomes 450. Now again, Satish, no, we will not discount it again also. Now here also I will keep a buffer, or I will keep a risk premium. Why I'm keeping a risk premium? Okay, going little bit off the topic. Tell me, how many of you have made plans to go to Goa or go to any other place with your friends? How many of you have made plans? Tell me. And then the plan got cancelled though, but tell me, how many of you have made plans? Right? I think almost everyone. Come on, guys. Already went also. Okay, fine. Then you will be better positioned to answer this question. Now, when we were making plans, we make estimate that, okay, if we will go, this will be the flight tickets, this will be the stay cost, this will be the fooding arrangements, right? This will be the amount for all other activities, right? Total amount comes to rupees 50,000 per person. Let's suppose comes to 50,000 per person. But we say, okay, let's keep a buffer of 10,000. Total comes to 60,000 per person. Let's suppose, right? That's what we do. We always keep a buffer of 10,000 or like whatever amount we keep a buffer. Tell me yes or no, we keep a buffer or not? So if we are keeping a buffer for that one, why not we'll keep a buffer here, right? So we are keeping a buffer here, right? So basically now this amount, let's suppose, becomes 650. This amount comes to 650. Now we have to discount this amount. This present value will calculate, and this present value is the value at which we will calculate the provision for decommissioning or restoration. You can say decommissioning, restoration obligations, decommissioning and restoration obligations. This is the amount. Is it clear now? Is it clear now? All of you, come on, tell me, guys. Is it clear to all of you? Now, so what we have to do, we have to capitalize it with the asset. So what is journal entry? The journal entry will be asset account debit to provision for dismantling, decommissioning or restoration costs. Can we discount the cost further? Satish, I didn't get your query. Can you please repeat it once again? Now, this provision for decommissioning cost will be unwinded on each reporting date. On each reporting date, we will unwind and record what? And record finance costs. Normally, cost at the end is lower due to updated technology. Now understand, if you are saying this cost is lower at the due to updated technology, see, we are not aware of it as of now standing, right? So this risk premium, the company has to estimate it. Okay, it might be the case that there is no risk premium. Okay, that depends upon the company to company. Okay, it can be plus, it can be minus, both. It can be plus, it can be minus, both. But being on a conservative side, we take plus only. Okay, because it's better to make a higher provision and incur less cost, but it's not good to make a lower provision and incur higher cost in the future. Okay, so that's all about the provision for dismantling, decommissioning or restoration cost. Tell me, guys, anyone having any queries? Yes, the unwinding finance cost goes to P&L. The unwinding finance cost goes to P&L. I'm here only, I'm not wrapping up the class. Tell me guys, if you are clear on this one, and if you have any queries, please discuss that with me. Yes, I am showing that diagram again. If anyone has any queries, please discuss that with me, guys. Come on. Why are we taking risk premium at a future date using VAR? Can we have an option? Can we have it inception too? Now understand, we need basically what the standard wants to say, that this cost will not be incurred today. It will be incurred at a future date. Right now, if we are incurring at a future date, so first we have to adjust for the inflation, and this risk premium is nothing but just a buffer to for the additional expenses that we cannot predict. Okay, so that's the reason why we are adding the risk premium at a future date, not now. Okay. Is it clear, everyone? Now, in the next class that is going to be held tomorrow, same time, 9 a.m., we will be completing this property plan and equipment. We'll be solving certain examples from good examples from the BPP kit or the you can say the Kaplan kit. I will take up a few questions, okay, which are important ones, though they will not be questions from an exam perspective, because exam perspective questions are not asked from one particular standard. They are asked from 2-3 standards, and we are not in a position to solve any exam questions of now. Okay, so for that we have to study at least 3-4 more standards. It is then only we'll be able to solve exam questions. But at least we'll take up some examples or illustrations from the BPP kit or Kaplan kit, whichever is good, whichever examples are good. I'll take up either of them. Okay, now, and we'll complete 16, 38, and 40 by tomorrow end. Okay. And always remember, after I complete 2-3 chapters, I will be taking up your mock tests. Okay, not of 100 marks, might be 30 marks or 35 marks or 25 marks. In that range, I will be taking up mock tests. Okay, wherein you have to solve 2-3 questions might be, and I will discuss. So now the mock test which I take during these sessions, okay, I will not be evaluating each and answers in individually. Rather, what I will do is I will give you the questions. You have to solve those questions, and in the next class, I will be discussing those questions with you guys, wherein you have to evaluate it on yourself. Now, when I will take the mock test for 100 marks, one mock test I will evaluate for you guys. Okay, for everyone. That's all for the day, guys. Thank you. Bye-bye. I hope you enjoyed the session. Sure, we'll do that. Bye-bye.